Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Phil Trepetowski.
And I'm James Sivko.
I'm sure it's not a shocker. I'm amped up. There's some very interesting stuff happening in the automotive business right now. We'll talk about our Fountain Ford dealer performance, over 100 dealers now. Very exciting. We'll talk about a reality check. What is the real cause of some of the pain in the automotive space right now? If you're a general manager, if you're a dealer, what's really causing the friction, and what information can Fountain Ford provide you on the Market Minute to help make your next best decision? We'll talk about incentives and loan rates, forecast for year end, a consumer check-in, and is help on the way, and what is that going to look like? Let's talk about national performance here. If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support. So a little bit of a reality check off the bat. Let's look at October versus September. Leads down again, appointments down again, new sales just a little bit up, and then used sales down. Well, let's go September versus August first. September leads were down 6.1, appointments were down 6.1, new sales down 10.3, used sales down 11.1. Well, then we go in and we see down 4, down 2.8, plus 1.6, and then down 4.5. So it's like, well, we could take a couple of left jabs and then maybe a right cross, but then all of a sudden, when we take an uppercut and a right hook, we're sitting here and we're like, well, what the heck is happening? How do I get out of this mess? Well, one thing that's interesting is, let's go to the year-over-year numbers. Let's look at the real cause of the cause when it comes down to our pain. Now, in the pre-brief, Phil and I were talking about this. The actual units being sold are essentially the same, if not up, depending on categories. Mr. James Sivko talked about the fact that, hey, if you have a bunch of cars on your lot versus SUVs, you're getting hurt more than others. So that's an asterisk above everything. But the real reason why the pain is coming is two things. Costs continue to rise in general, or have held steady, but at a bare minimum, they've held steady, and the majority of them have gone up. But Mr. Phil Trepetowski comes in with, there's a bunch of margin compression. So if we're sitting there, we're selling the same amount year over year, but now we have increased costs of the dealership as a whole. We have to pay our good people, for sure, more money, and even mediocre team members cost more money. And then also we have margin compression because we have dealers that are trying to take market share who are getting really, really aggressive. And those that are like, oh, I'm a little afraid of what's going on, I'm going to pull back. Well, the problem is the dealers that are pulling back are also the ones that are not as aggressive in the merchandising. So let's put those together. You have more expenses, you have margin compression, you are not merchandising as aggressively, which means you're not getting as much lead volume per dollar spent. You're also spending less. And then there's guys down the road that are choosing to do the opposite of all of those. I think it's worth the reality check to just sit there and go, well, that would cause a lot of pain, especially if you're a rural store. I had a great conversation with Evan Harris out there in Warrensburg in Missouri, and having the discussion. He's like, hey, my expenses are up here, 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 and here, but I hear that people are underspending, they're pulling back. I'm spending more to go acquire, because right now it is cheaper to acquire a customer when people are pulling back. Again, another asterisk on that, overgeneralization there, if you will, and I will. But it's not time to be looking at Thanksgiving, sitting there wondering when some stuffing and some yams is going to come out. It's time to put the pedal down and get off our ass and just really try to shake up going into the end of the year. So, Philski, go ahead.
Coming from a different angle here, the Fed has now cut rates in back-to-back months. Quarter point in September, quarter point in October. So surely that's leading to more affordability in the space, correct? Well, not necessarily. If you look at new average auto loan rates, you can see that the average auto loan rate for new vehicles actually increased by 32 basis points in September, and it's up 19 basis points throughout October. So we're seeing affordability still be a major hurdle for many consumers here. And if you look at the used average auto loan rate, that was up 25 basis points in September, and it's up another 5 basis points in October. So despite the efforts of the Fed, we're not seeing those yet materialize in the average auto loan rates so far. And with that, we've also seen manufacturers start to pull back on incentives. You saw they got very aggressive as the EV mandate was coming to an end. We did see incentives overall improve a number of months ago, but in September and in October, again, as rates have actually been getting higher despite the Fed cutting, we're seeing manufacturers pull back. Now, historically, we have seen manufacturers get aggressive into year end. Will they do so again this year? That remains to be seen.
My simple mind here, it's like, oh, I'm the manufacturer. I know more than the guys at the market minute here. I know that in general, September is going to slow down, October is going to slow down. I know that the EV credits, et cetera, are ending. Well, surely I'm going to go and I'm going to get aggressive on my offers. Or am I sitting there and I'm just like, screw it. I already know they're not going to buy more vehicles. Is that just throwing in the towel for a couple months?
It's possible they could try to just kitchen sink this quarter. It's also possible that if there's one or two manufacturers out there that really want share, they could offer some incentives and probably grab market share here, right here at the end of the year. So we had a difficult October. The numbers just came out this week. It is a 7% decline in US car and light truck sales. We'll go over what segments of the market were weakest, but certainly that is something we were seeing in the data here earlier in the month, that we were going to have a harsh down month. You can see it right there at the edge. It's still a decent month in terms of volume. We're still sticking to our 16.0 million forecast for the whole year. That could include two relatively weak months ahead, but we think that 16 is still an achievable number for the industry. And really, the only place to hide in any kind of retail, automotive, anything was Mr. Car Wash. That was the only stock that was up. It didn't matter whether you're a used car company or you are a luxury dealer or you just sell, regular cars and trucks all around the country or even campers. It didn't matter what you were down. These are some pretty big moves. And so the volume downshift was sniffed out pretty quickly. That and the tricolor news and some of the subprime automotive news, I think, really captured Wall Street's attention, and they really downshifted growth expectations across the board. We'll see if we get a bounce or not, but the world's greatest weighing machine has weighed that sales growth is going to be a lot lighter next couple of months.
Everybody see the news about Carvana's Chrysler store? Number 9 in the nation. Hello, franchise dealers, watch out.
Making waves.
So let's look at this table. If you'll notice, Americans don't want cars, and they really don't want cars. And affordability is quite difficult right now. So SUVs are more expensive than cars in general. Affordability sucks. That's a pretty tough spot to be for a car dealership, because it's like, well, I'm going to sell them these $40,000 to $100,000 vehicles. I'm going to stretch out their loans really far. And oh, by the way, these compact cars are just going to sit on my lot. And even if I incentivize, they don't want to drive a car. They want to drive a Mazda CX-5. They want to drive a RAV4. They want to drive a Jeep. I mean, mid-sized car is dramatic.
As I've been talking to stores over the last 30 to 60 days, as we've seen the market soften in certain areas, you're seeing brands like Mazda or Subaru who are a bit more reliant on some of these mid-size and compact cars to really move volume. You're seeing some of the worst overall volumes come in for major metros that we have seen in the last 2 to 3 plus years. So it's just been very apparent in certain markets, and especially with certain brands, you're seeing them really struggle, especially as just incentives from the manufacturer really hasn't been there on a lot of those models.
Consumers have not complaining a lot about high interest rates and credit conditions. This question that the University of Michigan actually asks is interest rates and credit. So it's been a support in the market for the last 2 or 3 years that consumers are less concerned about the financing package for their cars. A worry for us would be that as rates go up for loans and as lenders pull back on terms, that this would spike. And so we'll be watching this very carefully over the coming months to see if this is yet another headwind for sales. You can see how quickly consumers adjust. So this is 24 months of change. High prices were half the complaints. We know you hear these complaints all the time. Why I'm not buying today. The complaints were prices and to a much lesser extent credit. And they both have really been improving over the last 24 months. Consumers saying that it's a bad time to buy a car has dropped over the last 24 months. Again, we'll be watching this very carefully to see if this trend turns around. But consumers do have the wherewithal to adjust. It just takes them a couple of months to do so.
I believe if I saw correctly, 30-year fixed looks to be down about 80 basis points from January of this year, approximately. I realize that on a $500,000 loan, the weight is much bigger. Hopefully, we could see these rates for car loans have a 100 basis point drop over the next maybe 12 months, maybe even more.
There's a lot of room when it comes to new car loans over 9% on average. That means there's a lot being struck at 10 and 11%. There's a lot of room for that number to come down. So hopefully it does. So consumers here, we are a little worried about what's going on here on the lower left graph. This puts consumer mood down in the 13th percentile, going all the way back to 1975. So consumers are the most cautious overall when it comes to just consumer spending in general. And these graphs are simply, is it a good time to buy a car? Minus, is it a bad time to buy a car? For the last year and a half, we have seen this decline, and it hasn't been rates and credit. That has actually been a support in the market. So these latest changes in the financing picture, we hope won't cause that line to turn down. Certainly, it has turned down over the last couple of months.
Is help on the way? What should consumers be looking forward to as we go into the close of 2025 and we look forward into 2026?
The key here is to stay in the phone book. If you can stay in the phone book to January, February selling season, consumers are going to get, on average over the last 10 years, $330 billion of tax returns. And a lot of them use that as the springboard to go buy a new car or truck. And so January, February are going to be busy like they always are. And you should be planning for these tax returns to come. This is the selling season. And there is no expectation for this number to be weak. We will be tracking this. We've got a tax return tracker here at the Market Minute. So we'll be able to put all of this in context for you and tell you how this season is going down to the day in terms of what the pace of these tax returns look like, and if we're having a strong tax return year or a weak tax return year. So our goal collectively is all to just stay in the phone book here to January.
I'm intrigued to see how these manufacturers respond with Black Friday coming up, and especially intrigued to see what incentives look like throughout the month of December. I know that there is some uncertainty currently surrounding the tariffs and the legality of them. But as we were talking in the pre-brief, should there be a Supreme Court decision, manufacturers and consumers should not expect, regardless of that decision, any immediate impact. Take some time to flesh out how is this actually going to impact manufacturers should that maybe be overturned. If not, tariffs are here to stay. Again, we've had 2 Fed rate cuts. The market is currently pricing in an additional one in December. However, Powell in his last meeting came out and he pushed back, and the percentage did drop, I think, from around 90%. It's currently around 70% the last time that I checked. So the market is still anticipating another Fed rate cut. Are we going to see that materialize into improved affordability? Maybe not right away, but Stephen, as you hinted earlier in this video, possibly next year, I'm really hopeful that we'll start to see some improved, reduced auto loan rates and improved affordability, as we hit tax season and throughout 2026.
Me too. A little closing remarks here. The truth shall set you free, but at first it might piss you off. When dealers are pulling back, what I would say to all dealers out there is do not let uncertainty create inaction. When Phil and I are meeting on a weekly basis right now, we often focus on our churn rate, losing dealers. We want to make sure that we keep dealers for as long as possible because we know for certain that our strategies are highly effective. Now, with that said, hitting the oh shit button in the automotive space is very easy. Every month is like a new year. I know if you're a dealer watching this, I'm preaching to the choir, if you will. And so now is the time when growth is at a discount. Fear is high, growth is at a discount. That is my opinion based on the objective reality from just reviewing the data from our dealers over the last 15 years. If you're currently struggling, you're spending money, but not enough salespeople or not enough inventory, there's no reason for you to keep us. It sounds like shit. And I'm sure Phil's sitting there and it feels like, well, I've heard that before. When I say there's no reason to keep us, it's like, well, why would you go and put a system in place that's made to grow? If you're going to go batten down the hatches, the last thing I want you to do is just spend money to spend money because you're not going to get any juice out of it. And so again, what I would say is do not let uncertainty create inaction. Growth is currently at a discount. Stores that are growing, I mentioned Warrensburg, stores that are growing will continue to grow. Talk about Waxahachie. Stores that are growing will continue to grow. And those around you that are in this uncertain, inactive, or inaction phase, their expenses are only going to grow, and inventory will most likely build up, and salespeople's frustration will build, and it creates really tough situations. And it doesn't mean I'm not empathetic to the fact that things are tight, no doubt. But just keep in mind, growth is currently at a discount, and everybody's going to go back to selling more vehicles in February, March, April, June, etc. in selling season. Now is the time to look in the mirror and determine what actions you're going to take to double down and take market share. For my esteemed colleagues, Mr. James Sivko and Phil Trubetowski, my name is Steven Georgella. Happy Thanksgiving, and God willing, we will see you again next month on the Automotive Market Minute. Peace.